Now, microfinance companies have been under pressure. Goldman has downgraded their rating on credit access. Abhishek is here to tell us that. Abhishek, morning.
Morning, Prashant. So Goldman Sachs has downgraded credit access Grameen to sell from buy. They have cut the target price by 60% to 564 from 1,426 that was there earlier. They say that earnings visibility is clouded amidst asset quality concerns that is there, and de-rating structural in nature now for CredAc. So they have been negatively surprised by the acceleration seen in the decline in asset quality in Q2 of FY25. So they expect deterioration in asset quality to accelerate further, and also the impact from MFIN regulations will be felt in CredAc book. So they cut the EPS by 40 to 50% over the next two fiscals, that is FY25 to FY27. They expect credit costs to remain elevated over the next 2 years, and valuations don't adequately reflect the underlying stress in the book that is there. Back to you.
All right. Thanks very much, Abhishek, for that. Market open coming up, and you'll see the credit access stock also in a bit. But as always, we start with indices about 0.25% higher, 23,984. You got the Nifty Bank, which is up about 1/3% up, so 52,073. And mid-cap index, I saw some green, but now some red as well. It's kind of flattish at this point in time. 60 points on the Nifty. You've got the IT index, which is down about 1/3%. I can see that 2:1, but this is just too early for making any conclusions about the broader market. The Nifty heat map is telling you that you've got 39 odd names in the green, and a minority of stocks which are starting up in the red. But it's about stocks. Survi.
And let's start with insurance right there. And there is recovery after yesterday's big drubbing on these stocks. HDFC Life, SBI Life are up about 2%, about 1.5%. Even the non-Nifty names. Look at ICICI Pru, 1.5% up. Max is up about 1.5%. So even LIC, almost 2% higher. Recovery on life insurance, that's theme number one. Let's come back to the Nifty and see what else is moving. Some of the gainers include Adani Enterprises, Sun Pharma, Adani Ports. So some of the Adani stocks are also recovering from the looks of it. There's buying on Lever, Reliance. Some of these heavyweights are doing well. HDFC Bank can be counted in that list as well. So these are some of the early movers. Titan, Tata Consumer. These are some of the consumer names that have started off positive. What isn't doing too well is technology. TCS, Tech Mahindra, HCL Tech, all those stocks are lower. Infosys is also down, and Power Grid is cooling off. So actually, Nifty is quite okay. Barring tech, almost everything is either flat or positive. And life insurance stocks are definitely on the mend, at least for now.
All right, well, let's take a look at a few stocks. Easy Trip, that stock is up, in today's trading session, so big volumes on that one. Adani Green continues to chug along. That's up close to 9%. Z Enterprises, I think you've spotted that one out. That's up close to around 8% now. Honasa yesterday was up, I think, close to around 10-15% in the last couple of trading sessions. Honasa today as well is up close to around 7% or thereabouts. So big move is what we're seeing. In terms of top, volume movers, you also have Man Infra. Don't normally spot that stock, but it's one of the top volume gainers in today's trading session. Credit Access Grameen continues to move lower. That's down close to around 11%. You have Kochi Shipyard as well. That's seen some profit taking. Now down close to around 3%. And Bharat Dynamics, that one as well, on the losing end. So the headline index bounces back. It underperformed yesterday. Today it's doing a relative outperformance, up 60 points. Well, the mid-cap index, well, it's mildly in the red, but the breadth of the market, you have three stocks that are advancing for one stock that's declining in today's trading session. Looking at the top movers as well, let's pull up a few stocks that are eligible for the F&O trading from today itself. Geo Financial, I think that stock had opened up with a green tick, so that's up close to around 1% or thereabouts. Zomato should come up for you on the screen. That is making fresh 52-week highs, as well as Swiggy. Yesterday, I think Swiggy as well did quite well. Zomato for the timing mildly flattish to a bit of a negative bias, while Swiggy as well, I think yesterday it went all the way to around 520, and from there it's pulled back a little bit. But a good start. Let's hope that the bulls can build on to this. NCC, that one is moving higher on very, very large volumes. And I was looking at granules as well. It appeared there is some long addition on that stock. So keep an eye out on that stock for the next few trading sessions. December could be a crucial month for this one. Granules should come up for you on the screen as well.
Yeah, NCC moving because of this large order win that they've announced, over 3,000 crores, this Ken Betwa link. By the way, Honasa, look at it. I mean, the fall was dramatic and the recovery seems to be equally dramatic. Yesterday, 10%. Today, you've got 7% on Honasa. This week's winnings for Honasa already 20%. So pretty dramatic moves over there. And Sagility is the recent listing, has put on 28% this week. And Friday's only just begun, 3% on Sagility as well. The Adani group of stocks, like Nigel mentioned, all the gains are pretty much intact. I mean, Adani Power, Green, Total Gas, all of these stocks are up and about as we look at them. Let's just check some of the PSUs. Yesterday, the PSUs managed to buck the otherwise weak market trend. This morning, let's pull up NMDC and the likes. NBCC and Hoodco. These were the stocks that announced order wins yesterday. They were up and about. Union Bank is up about 2%. IOB, so some of the PSU banks are still carrying on, but the other stocks, Hoodco, IRFC, RVNL, NBCC, they've come in for a bit of profit taking.
Credit Access, right? That is the one which is selling off hard, and it's a big knock. It had come up a little bit from the lows recently, but guess what? All of that basically it recovered 10% from the lows. And it's giving back those the 10% once again. So we're pretty much, I think, in the lows of the cycle so far as this one is concerned. The thing is, Credit Access is widely considered as the best in the industry. I mean, it's like the highest quality microfinance name. And if Goldman's view is this with Credit Access, I mean, I'm also wondering what the view is. If they have coverage on other microfinance companies, what the view is there. We'll see if this comes to fruition in terms of their view and whether there is more pressure. Well, I think we rushed Abhishek through into market open. He was getting us that view from Goldman Sachs. Abhishek, you left off saying 40-50% cuts to their earnings estimates for the next 2 financial years. I mean, that's steep.
That's very steep, and the stress in the MFI sector that we highlighted to our viewers in May of 24 has panned out over the 2 quarters, that is Q1 and Q2. And now we are seeing brokerages downgrade, stock price as well as recommendation on lenders with MFI exposure. So Goldman Sachs is the first one, and this is one of the biggest downgrade that you are seeing in the MFI lending space. On Credit Access, Gramin, they have downgraded to sell from buy, cut the target price by as much as 60% to 564 from 1,426 that it was earlier. And they say that earnings visibility is clouded given the fact that asset quality hiccups are seen, and there are concerns with respect to asset quality in the near future as well. De-rating structural is in nature right now, and they expect further de-rating of Credit Access, Gramin. They have been, the deterioration in asset quality, which they expect it will accelerate further, given the fact that there are new guardrails which have been put by MFIN. So MFIN has actually reduced the number of lenders to a single borrower to be at 3 from 4 that they had earlier. So they have cut the EPS by 40 to 50% over the next few fiscal, that is FY25, 26 and FY27 as well. They expect credit costs to remain elevated at 6.5% or 6.6% to be precise for FY25 and about 4.5% for FY26. So valuations as per them don't adequately reflect the underlying stress that is there in the sector as well as the book. Also, they have written on financials, that is Goldman Sachs has written, they say that, sizing the microfinance stress could be as high as $4 billion to $18 billion, which is like almost 1.5 lakh crore of, stress that they anticipate in the microfinance segment, which is, potentially on the higher side if you take a look. So they have a sell rating on Credit Access, Gramin. They say that you should, or one investor can buy, AU Small Finance Bank, L&T Finance and IndusInd Bank as diversified players are better placed than only microfinance lenders. Back to you.
All right, Abhishek, thank you very much for that. So that's a more detailed kind of explanation of what Goldman is saying. Credit Access, by the way, from the opening lows, it's up about 4% or so. But this is still very, very early days. It's a still big 7.5% cut that you have on your hands. The other thing, of course, is that if you look at microfinance lenders across the board, Credit Access maybe has the lowest rate of lending. So, that's the other thing to consider. And it takes me back to the earlier point that what about the others? I mean, only MFI players what happens to them if this is the state, as Goldman puts it, for Credit Access. Devina Mehra is our market master of the day, founder, chairperson and managing director at First Global. Devina, great to have you with us here. Thank you very much for your time. Prashant this side. I don't want to talk about microfinance and what stocks, etc. will do, but just use that as an example to ask you whether it does show stress in the system. the consumer stress at the lower end? And how would you read it? What are the implications, not just for MFIs per se, but for the broader ecosystem?
Good morning, Prashant. So you talked about the stress at the kind of bottom end of the market, and that is something which most people have discovered only after the market corrected. But this is something I have been speaking about for many quarters, that there has been a consumption slowdown, and that's not happened just in the last quarter. If you look at the last financial year, 23-24, and you look at just the consumption number out of the GDP, that was the lowest it has been in 21 years. So, that was very much visible. Your GDP was essentially running on the single engine of government expenditure. If you look little broader term, there's this book called Lilliput Land by Rama Bijapurkar, and that showed how for the bottom 60% of the Indians, their real income has fallen from 2016 onwards. That for them, the income minus even routine expenditure, I'm not even talking medical or marriage or anything, is already negative. So if you parse it out into what you see in corporates, once again, if you see entry-level cars, the numbers have actually been dropping. So people have not been going up the income ladder. I sometimes see some talking heads on your TV, on your channel, a few months ago saying, oh, all of my friends are buying luxury homes. They're all buying luxury SUVs. The economy is booming. But people like us are not the only people who are there in the economy. So yes, there's stress. If you talk of credit in particular, I was a speaker at this business summit, and one of the things which was like a light bulb moment for me was when Mr. Kamath said, I mean, these two stresses I had talked about separately, I had not put it together, that you think about all the losses in the F&O markets, and those are mostly made by individuals. So I think the figure is something like 1.5 lakh crores or something like that. And Mr. Kamath said, just think about how they have been financed, and almost all of them would have been financed through unsecured credit of this kind. So that's another, direct market related point that goes into credit. And many of the fintechs and all the smaller players have been going down the credit score. The credit score at which banks wouldn't lend is where these guys come in. So there are many stresses in the economy, but they have been there, as I said, for a while.
The thing is that I think the RBI has been quick to tell a lot of the lenders to go a little easy on things like unsecured, etc. Right? They raised the alarm bells a good year in advance almost. I remember when the risk weights went up. So hopefully, I mean, I guess that's the hope, Devina, that this is not going to spill over beyond microfinance. Actually, let me ask you that first. Do you think this will be contained? And what are you doing in financials? And let me throw in the whole insurance question as well. We spend the better part of the morning on that debate as well, because it seems that this banca channel, in some format or the other, there will be some regulation on how much of insurance sales can be pushed through banks. So tell us more about financials, both on MFI, stress, whether you think it will be contained or not, and a word on insurance.
So banks, we are underweight as usual. I would say the only time we were market weight to slightly overweight was 2022, which was the only year in the last 5 years that the bank Nifty has outperformed the Nifty. I mean, right now, if you just look at pure technically, the banks might do actually a bit better. That's that. But these medium to long-term concerns are what give me sleepless nights if I was invested a lot in that sector. As I always say, the problem with the banks and all lenders is that you only get negative surprises. It is not as if the borrowers do very well, they will get some supernormal profits. But if there is a problem, there is a hit. So that is the concern always with banks and lenders. So that's why as somebody was saying that you repeated in every interview of yours that I'm a nervous investor in banks and lenders. Very few times that you are comfortable being there. And a banker was recently telling me, I have not studied that myself, that gold loans have been going up. And he says that's another source of, indicator of stress in the system, because the jewelry is kind of the last thing people mortgage to get money. So those are things. Insurance, yes, there have been a lot of now changes being announced. We are still studying it. It's not a sector we have a big exposure to, so we didn't need to react immediately. So
So
they're just
beyond
delving a bit.
no, got your point. Devina, beyond the banks, and you've articulated the concerns over there. Financials elsewhere, and we're saying insurance, you don't have an exposure, but capital markets has been doing really well. People seem to be really gung-ho on the wealth management business as well. Just trying to get the overall picture on financials, even the non-lenders. If there's anything that you've bought in this recent correction or anything that you like.
We haven't bought much. We used to hold a number of capital market related stocks earlier. So the stock exchanges and players in the market and AMCs for that matter. But in our July rebalance, our system stopped liking them. I mean, or rather you can say that liked other things much better. So we actually exited most of them a few months ago.
Hi, Devina. Good morning and good to see you. And let's talk about the consumption theme then. Staples as well as discretionary. You have some allocation, I think 13 to 14% of the total portfolio. Could you tell us, as of now, where is the preference?
So I'll tell you overall which sectors, because this is a very broad level classifications. For example, autos go into consumption and so on. So so let me tell you where, in terms of the sectors that you and I understand, where we are overweight. So we would be overweight pharma and healthcare. That would be probably our biggest overweight in terms of just the percentages beyond where the benchmark is. IT, we would be overweight now. Auto components, we continue to be overweight. Where we have added, I'm not sure whether we are overweight or not, in the last couple of rebalances has been chemicals, which after 2022, we were basically mostly out of, and then our systems have started liking them again. And of course, chemicals is a very broad sector, so the winners, the losers, depending on where in the chain you are. But that's one sector where we would have added. FMCG also, we have added some. I mean, we had a very low allocation, and we've added in the last two rebalances. But not so much of the very large companies.
Yeah, got that. Devina, the other thing, of course, which you track closely is global markets and global macro, etc. Now, Mr. Trump has put together his economic team. They all seem like they all dislike China. No particular views about India in that sense, which is I guess silver lining and good news. So they all train their guns on China. But for the market here, is it going to be a little tricky? It's a minority view as I remember Christopher Wood of Jefferies saying that Mr. Trump is inherently, he's transactional, and of course he's unpredictable. So we don't know how much of how should one view this from an overall perspective as we head into 25.
So I wrote a whole article yesterday on this, on that only thing you can say for sure with the Trump Sarkar coming in is that uncertainty has gone up because a number of things he said during the election campaign are inherently contradictory. So, for example, he said that the U.S. The average worker the income has not kept pace with the inflation, and there's been loss of purchasing power. Now, if you put a 60% tariff on China, you put tariffs on everything from Mexico and Canada as well. So for good measure, he said that as well. So that means everything on the supermarket shelves, the prices go out through the roof and inflation goes through the roof. So, I mean, you are not even sure. I mean, that's only one contradiction. Defense stocks, for example, went up with his re-election, but he has also said that why should US spend on these overseas wars? So there have been so many things which are at loggerheads with each other. For example, if you really cut government expenditure drastically, government expenditure is 36-37% of US GDP. So that would be deeply recessionary. He says the US dollar should not be so strong in order for exports to be helped, but a lot of measures he's talking about would actually strengthen the US dollar. And to add uncertainty to the mix, his main advisor is Elon Musk. So if you wanted to compound uncertainty, you have a dream team there. So very difficult to predict even what he will do. Then what he does has an implication of on inflation, on what Fed does, on interest rates, and the third order effect is on markets. The fourth order effect is on international markets. Then you have geopolitics, where you don't know what he will do, how the other players would respond. So they're like just infinite combinations if you go into game theory as to what would happen. But I don't think there's a lot of direct things which will impact India. I doubt it, unless he does something which impacts IT services or something, so that may be the only possible risk area which directly impacts India. So the rest of it, we'll have to wait and watch at least what he does before one can predict what will happen. Inflation already is little bit higher in the last print that came 2 days ago. So, that leaves again little less headroom for Fed to cut rates.
Sure. Yeah, I think we'll just have to wait and see. Direct impact could be whether we have Teslas on the road here in India, as well as Starlink, whether Mr. Musk manages to use his good friend's influence to open some doors here in India. I think we're in for interesting times on that one as well. Devina, always a pleasure having you on the show. Thank you very much for joining in, and we look forward to the next call. You have a great weekend, and thank you for joining us this morning. Okay, quick check on the market before we move to our next guest. The market's actually galloping along quite nice and steady. 100 points up on the Nifty, and 24,000 is back on the screen. So there's a nice large cap recovery that's in the works. Okay, we're putting the spotlight on the banking space, in specific Union Bank now. The second quarter was a slightly weak quarter for the bank. Loan growth has been weak if you compare it to peers. And obviously the fight for deposits remains a big talking point for banks across the board. So how is the second half likely to shape up? We have with us Mr. Srinivasan Varatharajan, non-executive chairman at Union Bank of India. Sir, great to have you. Thank you very much for joining in. Before we talk about growth, I want to sort of start with the whole asset quality question, because not just for you, and you also saw a big rise in slippages. Your slippages in the second quarter were above 5,000. That was, I think, almost doubled, more than doubled. But this is a larger question, right? We're looking at some Goldman Sachs notes right now. They're trying to estimate how big the MFI stress pool could be, and it's running into billions of dollars, those estimates. So first, you tell us whether is there any threat at all of a spillover of the MFI stress into other parts? Or maybe not, because anyway, MFI is very niche, and banks are anyway not lending to those kind of customers. And B, even without MFI, is there more stress building up? What are the trends that you're seeing in the third quarter, given the rise in slippages that you saw in the second quarter?
Good morning. Thanks for having me on your show. So I think as far as asset quality is concerned, I think the central bank has been very proactive in terms of trying to guide the banks, as well as do some macro-prudential measures to ensure that the right actions are taken by all stakeholders. So banks, if you look at the products which to some extent stress was building up, I think those products have broadly slowed down, and you can see that over the last 2 to 3 quarters. So I would believe that, yeah, the asset quality thing, I think we hit a trough in terms of what exactly slippages would be for the system as a whole about in the last financial year. From there, it'll tick up, but the ticking up is not going to be something which is going to be anything large, and it's going to be anything systemic. On the whole, I think it'll be something which banks will be able to absorb and move on.
So can you quantify that? Maybe not for a system as a whole, which is a larger, bigger guess, but at least for Union Bank. When you say that overall stress will tick up, to what extent? I mean, what is the kind of GNPA movement that you're factoring in by the end of the year and next year as well?
I think it will be broadly around the same levels which you've seen over the last 2 quarters.
Which means gross NPAs would
if you look at the last quarter, I think some of the slippages were driven by some large asset slippages, single accounts in terms of large corporate. And I think if you look at outside of that, the slippages are fairly well contained. And I think that's how you look at it in terms of segments which you're talking of, which is basically small ticket lending.
Okay, so would that mean that your gross NPA levels would be contained at around 4.4% thereabouts for the end of the year?
Yeah, I think, yeah, it'll be around the same levels where we've seen.
Okay.
All right.
I think one thing you should understand is, I think,
Please go ahead, sir. Please go ahead, sir. Complete that point, please.
No, I'm just saying that the broad level of slippages as well as asset quality ratios would not be very different from what you've seen over the last couple of quarters.
Got it. All right. Hi, Mr. Varadarajan. Good morning and good to see you in. This is Nigel on this side. I'm looking at your advances as well as deposits. You know, out there, the growth has been slower than what we're seeing in the industry, which could, the read-through could be that you're losing market share. Could you tell us if this is strategic in nature? And what is the outlook on both these two fronts for this fiscal and the next?
Now, if you look at what's happening for the system as a whole, clearly deposit growth has been lackluster and has been lagging credit growth for the last many quarters. And that wedge is sort of right now contracting. And I think that is coming on the back of credit growth coming down. Credit demand has been reasonably low. And it's important to make sure that you do credit where it is remunerative for the bank. And then to that extent, I think the bank has been judicious in terms of what sort of credit it undertakes. And the resultant thing is that deposit growth has been marginally lower than what the system is because credit growth pickup has been fairly muted for the system as a whole.
So what's the outlook? I mean, I guess this is also a function of banks trying to shore up deposits, also focusing on asset quality, which is why credit growth has come off a little bit. But if you could just elaborate, I mean, for Union Bank, how do you think you'll end the year? Last quarter, year on year, you were up about 10%. So how will you end the year on credit growth?
Broadly in the range of 10 to 12%, 10 to 11% range. I think that's the idea. But broadly, what you should look at, I think I'd like to stick to what the system would do over the next couple of quarters, is that if you look at the one thing which has not bothered the market is currency, and that is what is top of mind today. And whether it is the dollar index or whether it's what's happening in terms of the rupee. So clearly, from a point of view of liquidity and in terms of how exactly currency moves are going to be there, I think that's going to be broadly driving deposit growth. And liquidity, in my view, rate cuts as of now keep getting postponed. Liquidity continues to remain fairly tight. So therefore, to that extent, I think deposit growth is going to be not galloping away. It's not going to be much higher than where we are today, with the result that credit growth will be where we see it here or slightly marginally lower for the system as a whole.
10 to 11%. Before we wind up, Mr. Varadarajan, wanted your view on the NIMS outlook. It came in at a multi-quarter low in the past quarter. So what's the range we should work with from here on? If you want to give us a guidance on the return ratios that you can achieve in the coming year.
Now, I think the management was on air post the last quarter results, and I think I would just like you to refer to the guidance given by them, and I think that's broadly, as I said, around current levels.
Srini, hi, morning. Prashant here. I don't know if you heard Devina Mehra, who was with us from First Global earlier before you, and she was quoting Mr. K.V. Kamath and what he said at a recent event. And this is a broader industry question, not about Union Bank. She said Mr. Kamath essentially said that a lot of the, and this is his thinking, I mean, he was I think, throwing that thought out. He was saying that maybe a lot of the capital market losses, especially on the F&O side, over the last couple of years, perhaps could be being funded by unsecured loans. I don't know if you have any thoughts at a general level.
I think that's been a concern in terms of end user funds, and that's why RBI sort of acted in terms of putting in place some microprudential measures. And I would think some of those losses have not happened on a single day. It's been happening day on day over the last couple of years, and therefore whatever things need to happen in terms of the asset quality, I think is already taken place. And incrementally, I think the amount of exposure which people are taking in F&O is going to come down on the back of SEBI's measures on F&O. And therefore, I don't think this is a problem which has grown larger day on day. I think the problems whichever have happened, I think have been taken in by the banks and NBFCs. And I don't think so this is something which will linger on going forward. The problem is in terms of some of these end users on consumption, which broadly, where the cash flows of borrowers match the liabilities which they have to undertake. And I think that's the broader question. I think the capital market thing for banks is a much smaller question in my view.
All right, we leave it there. Thank you very much for joining us, and it's a pleasure. Have a good conference at Trust. Thank you indeed for being here on CNBC TV18. We'll take a quick commercial break here. Saurabh Gupta of Dixon Technologies will be joining in. It's one stock which has done phenomenally well. Motilal Oswal recently came out with another sort of report, buy rating, suggesting further upsides. That conversation comes up. Welcome back. 100-point triple-digit gains on the Nifty. So there'll be a nice way to wrap up the week. 24,000 plus is where the Nifty finally is ending at. In the first hour, the end of the first hour, not the end of the... It's a Friday, Surabhi.
Yeah. Counting down. The countdown is on.
The countdown is early in the countdown, let me put it that way. The Adani Group stocks, by the way, are doing well. Power, Green, Adani Total, Adani Energy Solutions, so this is the third day of recovery and repair that we're seeing out there on this particular space. Honasa is the other one. Honasa is up 6.5. Again, completely got smashed up, ended about 10% higher. Yesterday was the first day of recovery. It's up another 6.5. So just some additional names which were not there in the mix at 9:15. Well, let's talk about the EMS space. And the leader there, of course, is Dixon Technologies. Motilal is bullish on the stock. It's been a huge outperformer. And there is more coming if you go by Motilal. Saurabh Gupta is Chief Financial Officer at Dixon Technologies. Saurabh, it's always great to see you. Thank you very much. Good morning. Prashant this side. It's always, whenever we chat, Saurabh, what's the latest and what's the new thing at Dixon, which I want to know? Because you guys are always tying up, bringing in new partners. I believe there is work going on sort of getting a couple of more Android players to partner with you. Those talks are on. So tell us, what's incremental, what's new, and in terms of meaningful stuff?
Yeah, so clearly, Prashant, the mobile is the largest addressable opportunity. And within a short span of last 2 years, we have been able to get almost all the brands on the Android ecosystem. Some more brands are in discussion, and hopefully we should be able to conclude with them in the next couple of quarters. Apart from that, the focus in mobiles is also on the backward integration, deepening the level of manufacturing. So there is a component PLI which is expected, hopefully, before the end of this financial year. And we as a company, we think we'll make significant investments in displays, where we have already tied up with HKC. We'll be looking at doing investments on precision components, mechanicals, die cuts. So there we are pursuing partnerships. So we think we have an opportunity to take the value addition in mobiles from 17-18% today to almost 35-36% in the next 24 to 36 months. And we'll be making significant investments. So that adds to our strength, moat, and also reduces the cost of manufacturing in India, which makes us more export competitive as well. Apart from that, IT, I think, so is the next trigger for a growth.
Saurabh, sorry, we'll just come to IT in a bit. And that should improve margins meaningfully as well, wouldn't it?
Yeah.
On the component side, taking the share from 17 to 35%?
Yeah, significantly. We think it will start reflecting from Q2 of next financial year, because that's where we start manufacturing displays. And then over the next 24 to 28 months, I think, so the margin profile, which is presently around 3.3%, can increase by 120 bips over the next 28 months.
Okay, so, and these precision elements, components that you're speaking of, this would include things like camera modules, because I think in our earlier conversations, we've kind of picked up that interest in getting into camera modules. So all of these kind of components will lead to this margin expansion, right?
That's right. So camera modules, mechanicals, precision components, and die cuts. So these are the 4 things that we are working on.
So just to understand, mobiles continues to be the largest segment for the company. Just give us a targeted mix, because then there's sort of IT components also picking up. Say FY26 end, what is the contribution that you'll still get from mobiles? How is the sales mix going to change as some of the other segments also kick in?
So my sense is it will still continue to be around 60 to 70% of our revenues, anywhere between 60 to 65, because clearly we have a strong order book also in our telecom business and also in IT hardware business. So definitely I see some percentage contribution of mobiles coming down from 70% to broadly 60-65% as the other 2 verticals also start firing.
Okay,
so let's actually talk about some of those other verticals. IT hardware. So where are the plans right now, and when do you fully come to market? What are the timelines that you're working with? And I think a lot of types have already happened with some of the major hardware companies. Any more in the pipeline?
Yeah, so I think so. We have already acquired 4 large customers, which is HP, Asus, Lenovo, and Acer. For most of them, we will start manufacturing by Q4 or Q1 of next financial year. We're also pursuing partnerships on servers. So servers can be a very large opportunity for India, and we are pursuing some kind of partnerships. Hopefully, we should be able to announce something in the next couple of quarters. So IT hardware looks very promising for next financial year. And we think the overall addressable opportunity at a manufacturing level is almost $8 billion, almost 60,000 crores. And like the way we acquire a large share in each of the categories, similarly, we feel that over the next 2-3 years, we should have a large play in this category as well.
Okay, all right. Hi, Saurav. Good morning and good to see you. Well, display manufacturing, what's the kind of volume we can look at? I think in FY26, we'll be guiding for something like 20 million, which goes much higher in FY27. If you could help us out with a couple of numbers, display manufacturing.
Yeah, Nigel, so in the first phase, you're putting up a capacity of 25 million mobile displays and almost 12 million IT hardware displays. IT hardware display is already part of the PLI scheme for IT hardware. And in the next phase, we will take this 25 million to 45 million displays because we already have a large customer base on the Android ecosystem. So yeah, next year, broadly, it will start from Q2. So the first year, anywhere, we are hopeful that we should be doing somewhere around 14 to 18 million kind of displays. And then year on year, those numbers will increase because clearly there's a big business case. There's a big duty arbitrage on importing a display, so versus Indian manufacturing. And also, clearly, the component PLI will further add to the overall advantage in that.
All right. So 14 to 18 million for next year, right?
That should be the broad numbers, yeah.
And since your capacity is going to go from 25 to 45, the following year, we should work with a number of 30-35 million at least?
Broadly, it has the potential to double from there, those levels, yeah.
Okay.
Saurabh, just a couple of more questions. Just to, as we come closer and come to the fag end of the, not fag end, but yeah, I mean, the last month of the third quarter, you'll have better visibility of FY25 numbers overall. Closer to between 35 and 40,000 crores in revenues this year?
I think so. That should be doable, Prashant. We have done, I think so, broadly 18,600 crores in the first half. Definitely, I feel the second half should be better than the first half because the Q1 was slightly slower for us. A lot of customer ramp up happened during Q2. So yeah, I think so. The H2 should be better than H1.
Okay. One more thing from my side. This entire we talk about Make in India, but now there is Make in America. Make America Great, right? That is going to be the talking point, etc., over the next couple of years with Mr. Trump. One view is that he's going to use tariffs as a threat to essentially force companies to make in the US. As the largest EMS player in the country, Saurabh, do you think it's viable to make in the US? I mean, shift what is happening in countries like India, China, Vietnam, etc. I mean, to move supply chains onshore in the US. Do you think it's just too expensive and it's all just rhetoric?
I absolutely feel the same way, Prashant. US can be a consumption economy, but as far as manufacturing is concerned, the cost of manufacturing in US is very high. So my sense is there can be shift in supply chains in the Asian countries. I think so. India can be a big beneficiary. Clearly, I see that tariffs, if they are put, the increase in tariffs on a neighboring country will be far higher. And I think so India is well positioned because of the advantages that India enjoys on large labor pool, low labor costs, strong government policy framework, companies like us having a scale and size. So clearly, I think so India, I think so should gain out of this overall thing. But yeah, one has to wait and watch. But definitely, I feel that manufacturing in US is that tough. I would say it's not so easy.
Got it. All right, Saurav, you've helped us out with the business aspects. Just one factor I wanted to ask you. The promoter entity, they had around 34.5% stake in the company. And as of the September quarter, that's come down to a little south of 33%, to be precise, 32.89%. So very, very small selling is what we're seeing out there. Could you clarify about what's the outlook from here on? Because in the last year and a half or so, it's down by close to around, 1.5%.
So Nigel, it's a small selling. It's basically he's a first generation entrepreneur. I think
Yes.
so. He wants some liquidity for his personal needs, but
Yes.
I don't see he's completely invested in the company, and
Okay.
we clearly have a long way to go. So yeah, this is just a small selling. I don't anticipate any further selling broadly from this.
All right. Thanks for that clarity, Saurabh. And do communicate to Mr. Lal and the family. I believe there's a family wedding, one of his children. So best wishes from all of us here on CNBC TV18 and all the best to the entire Lal family.
Thank you, Nigel. Thank you, Prashant. Thank you, Sukhbir. Thank you.
Thanks a lot for joining in. Well, let's take stock of the market yet again. Sukhbir?
Okay, well, things are looking up, looking good, 128 points higher on the Nifty. And if we talk about some of the key movers and shakers, so there is a Cipla, which is the biggest gainer right now, 2% higher. Actually, even Dr. Reddy, some of the pharma names are doing well. And a couple of the biggies, HUL, L&T, these stocks are fired up, even Reliance for that matter. So it's sort of all hands on deck today.
Just one stock, Sukhbir, a Mazagon stock. When we started, we were talking about one of the stocks that were lower. That stock has done a complete U-turn. It's now at the high point of the day, up closer around 3%. So a few of these names have done quite well. PP Fintech as well, that's the other one. And Edelweiss Financial, these are some of the stocks that have moved up quite well from the low point of the day. So just trying to follow.
There's one more name is LIC. LIC is up 5%.
Because they don't
no
have any
banker.
So, and guess which were the other name yesterday, which was higher? Well, all insurance names were lower. ICICI Pru. ICICI Pru does not use ICICI Bank as a bank assurance partner, the parent. ICICI Pru is kind of flattish, but yesterday it ended higher. I think it was down substantially. LIC is up about 4.5%. So 780 coming through there. So there is a lot happening, and we'll continue to track individual names. Mitesh is with us with what he's making of the sort of trade and the setup so far. Mitesh, early days, or you trust this 100-point up move and bet on more? What would you do?
Well, Prashant, not much, honestly. I think, as I said, 24,120, 24,150 is the zone. So we might actually see some more points added on the upside, but till we cross and capture those levels, I would not be trading long on the index. On a stock-specific basis, yes, we have identified some trades which are looking good. Bata is something, which did not fall much in the decline yesterday and has bounced back immediately. And the structure is also improved dramatically here. So keep a stop at 1360. Look for a target of around 1410, 1420 on the upside. And the other stock which I like is Crompton, which can be bought with a stop below 400 for targets of 400.
Okay, all right, got it. Amitesh, thank you very much for that. So those are some of the calls coming through. Let's just go back to Credit Access and see what the stock is doing. It's still down about 7.5%. And this is after, of course, Credit Access having lost a lot of ground in the last couple of months. That's today's decline. Let's pull up a one-year chart as well on Credit Access. Stock's down about 40% this year. A lot of, there you go. So big decline through the year, but then this fresh sort of messaging that's come in from Goldman Sachs, that's leading to another round of selling today. Abhishek is joining in, and he's been flagging off the stress in the MFI space for several months now. So Abhishek, what's the latest on MFIs and of course on Credit Access?
Goldman Sachs has written on credit access. Grameen, they have downgraded the stock to sell from buy. Target price has been cut as much as by 60% to 564 from 1,426 that they had earlier. They say that earnings visibility has clouded given the fact that there is asset quality worries that they see for the entity going ahead. And derating is structural in nature for credit access, Grameen, from here onwards. So they have been negatively surprised by deterioration in asset quality in Q2 FY25. They expect a deterioration in asset quality to accelerate further given the fact that MFIN has come out with new set of guidelines wherein you have to reduce the number of borrowers, the number of lenders to a single borrower to 3 from 4 that they had earlier. This can mean slowdown in growth as well. So they have cut the EPS estimate by 40 to 50% over the next few fiscals, that is FY25, 26 as well as 27. They expect credit costs to remain elevated at 6.6% for FY25 and about 4.5% for FY27. So they say that valuations don't adequately reflect the underlying stress that is there in the portfolio. Now, Goldman Sachs has also written on financials. They say that the microfinance stress that could be as much as $4 billion to about $18 billion. That's a huge number that they have put in with respect to stress in the MFI portfolio in India. So they have a sell on credit access, Grameen, while they say that diversified players look better placed right now, like AU Small Finance Bank, L&T Finance, as well as IndusInd Bank. Back to you.
All right, Abhishek, thank you very much for that. So those are some of the names up on your screen as well, with that Goldman call coming in on MFIs and the downgrade on credit access. Z is the other one we want to focus on. Stock is higher. Vamakshi is here to tell us why. Vamakshi, morning.
Well, good morning, Prashant. Well, Z is definitely trading higher in the trading session today. Keep in mind that, the shareholders rejected proposal to reappoint Puneet Goenka as the director of the company at its AGM on November 28th. Now, this proposal was defeated by a 50.4% vote against this. In fact, earlier on, proxy advisors like InGovern and IIAS both had recommended shareholders to vote against his reappointment. And in fact, largely, when we look at the overall picture, nothing much changes for Puneet Goenka because he had earlier on November 18th as well stepped down from his position as the MD of the company and had said that he would like to concentrate on operational responsibilities as the CEO of the company, and therefore that still continues for him. So that is the news flow around Z. The stock as of now is up in trade.
All right, Vamakshi, thank you very much for that. So it's Z about 5.5% higher. Well, we'll take a quick commercial break here. Manisha Gupta is going to be with us, and we put the focus on commodities on the other side. Stay tuned.
Welcome back. Okay, so the equity market's holding up quite nice and steady. Let's figure out what's the latest in the commodity markets. We have Manisha joining in. Manisha, so what are you tracking right now?
Well, I'm looking at metals as a sector because more metals than rather seem to be heading for a strong week on this one. One, you've seen a bit of a pullback in US dollar index, and that has been supportive. The other thing really is about the rising cost at mines, underinvestments, declining inventories. All of that has been supporting metals as well. And the street is awaiting details on the US plans on tariffs. I mean, that detail would come in the first quarter of 2025. That is when you will see the markets settle down a bit. But until then, it continues to be volatile and slightly on the higher side as well. Also, there are yet again expectations that China could be coming out with some major stimulus before this year ends, and that has been keeping markets or other metals in happy favor there. I want to start with zinc because we're trading at a 4-week highs onto this one. Zinc seems to be outperforming many of these metals. One, the latest news coming in from Trafigura Group, which is ordered big withdrawals from LME. When you look at the last couple of days itself, the kind of withdrawals that we've seen in sense of LME are the highest in a decade, more than 97,000 tons. If this gets out of LME, then the kind of remainder inventories that we are looking at on LME are much on the lower side at just about 154,000 there. So this will keep the zinc prices under support. Other is aluminum, where we have seen prices continue to gain up. We did see 5-month highs in the early part of this week itself, while the prices have come off those kind of numbers, but the kind of fundamentals we are dealing with are still on the supportive side. Russia's Rusal is going to slash 6% of output. You have alumina costs, which have doubled to $700 a ton, and then alumina supply disruptions from major producers like Guyana, Brazil, and Australia will continue to support prices. You have lead as well, which is trading at a 5-week high, so more metals are actually trading at multi-week highs. I want to take you through a table which shows you on what we've done in sense of metals in last 1 week and in this year until now. So on a week-on-week basis, the best of gains coming in from zinc. We've told you on what really has led that rally. Aluminum has seen a 1% decline, but on an annual basis, we are 9.5% on the higher side. So two metals which have done the best really are aluminum and zinc. Copper from the higher side has seen a decline, and we've seen the net longs kind of continue to decline last couple of weeks. So that is what is putting pressure on the prices. But overall, yet another year where we would be closing it in the positive for many of these metals.
All right, Manisha, thank you very much for that. So that is commodities in focus there. Well, FMCG major HUL has outlined its growth and category targets as part of its Capital Markets Day. Mangalam is here with highlights. Mangalam, morning.
Morning. So the meet starts at 11:30. The company has uploaded its 270-slide presentation on the exchanges already. And these are, important ones to look at, not just for HUL, but the entire consumer sector itself. And what's promised actually happens, then it's a crazy look into what HUL 2.0 for this decade looks like. The key highlights, 2 to 4 times potential is what they see in terms of increase across categories. What has happened over the last 3 years is there has been a 200 basis points market share gain with nearly 1.3x jump in revenue as well as profitability. They also see about 100 basis points savings through efficiencies, and they've identified a bunch of brands, the likes of Surf Excel, Vim, Dove, Pond's, etc., at the sweet spot of premiumization. They are seeding a lot of premiumization in the beauty and wellness category, as well as food and refreshments. They've also spoken about 6 long-term opportunities, which is 1 in premium face care, premium healthcare, body wash, home care, condiments, as well as prestige and well-being. What's interesting, and this media analysts would be, very importantly tracking, their share of advertising on TV is actually down from 60% earlier to now 39%. A large part of their advertising goes on social media, so we'll keep an eye out on that one. They've onboarded 1.4 million retailers, and 50% of their revenue share is now generated from their Shikhar app itself. And to my mind, the most important development that the company's announced is that they've announced winning in many India's 2.0. Remember, WIMI 1.0, when it was first announced in 2014, was a transformative exercise to classify India into 16 socio-economic clusters. Now they've gone ahead and further classified these clusters into affluent agglomerations as well. So earlier you were talking about 16 spots in India. Now you are also, talking about that affluent market, which a lot of people are ceding share to a lot of these new digital brands as well. So if HUL goes ahead and does that over the next few years, we can see accelerated growth. The strategy is laid out. The important part is executing them.
Okay, all right, Mangalam, got it. Thanks very much. So that is the takeaway from the analyst day at HUL. Markets holding up 100 points higher. If you look at some of the stocks on the move, the insurers are still trying to recover most of the ground, but it's turning out to be a good day for pharma, by the way. Even Sun Pharma has now joined the bandwagon. So Reddy's, Cipla was always the Nifty gainer. And then there is Sun Pharma that's rising to the top now. That's pretty much how it is. But Prashant, you were looking at credit access once again?
No, I was just saying that, if you measure the total movement, it is up more than it is down. It is about 7%. Sorry, it's
what?
Basically, it's recovered 7% from the day's low.
Okay.
And now it's only
down. So up more than down. Okay.
That's a new one, right? But 50 points lower on 50 rupees lower on credit access, and it's come up very nicely. Well, see, it's just still, I think, the first hour, under the first hour, as far as open is concerned. We'll see where it goes from here. New entrants in F&O at the bottom of the screen, and we'll continue to highlight that as we go along. It's a wrap from all of us here on Bazaar, but don't go anywhere. Our special segment, it's the economy on the other side. My colleague Lata will be in conversation with Pranjul Bhandari of HSBC to discuss their expectation from second quarter GDP, which is due today evening. Stay tuned, that's coming up.
Welcome to It's the Economy. The big number we await today at 4 p.m. is the second quarter GDP number. Our CNBC-TV18 poll sees Q2 GDP at 6.5%, and that's the lowest in 6 quarters. This 6.5% compares with 6.7% in just the previous Q1 and 8.1% year ago in Q2. The Reserve Bank itself has forecast 6.8% growth for Q2, the quarter that ended on September 30th. But that is down from its earlier forecast of 7%. Now, our poll also sees the GVA, gross value added, at 6.5%, same as GDP, versus 6.8% Q1 and 7.7% year ago. The GVA actually is a better measure of the economy. GVA, you just have to add taxes, subtract subsidies to get to the GDP. Now, as per our poll, GDP is dragged down partly by poor showing of manufacturing and electricity. However, services are expected to have done well at 8.2%. Let's see. Looking at GDP from the expenditure side, the fear is that government capex or gross fixed capital formation, as it's called, which was doing well till about a quarter ago, may have slumped in Q2. Our poll also shows that some economists, including the Reserve Bank, see a very smart rebound in the second half. That's the CNBC-TV18 poll expecting 6.8 to 7% growth in the second half, Q3 and Q4. The Reserve Bank itself expecting 7.4, but not all people in the poll are agreeable to even 6.8 to 7%. So that 7% plus growth, which the Reserve Bank is forecasting, doesn't have too many supporters now. So have we given up the 7% growth pace altogether, which we had over the last 3 years? That we will know only in May of 2025, next May. But first, let's concentrate on the number that's coming later today, the second quarter GDP. We are joined by the chief India economist and economist for ASEAN at HSBC, Pranjul Bhandari, who's joined us in our studio. Pranjul, first up, I want to ask your estimate. Do you think we will even make it to 6.5? Because I had quite a few people saying 6.3, 6.4 for Q2.
Right. So we are at the 6.5% ballpark. That's our forecast. And fingers crossed, we'll know in a few hours. But I think the details are important. I think what we've seen really is urban consumption slow in this quarter. A bit of it has also come from the fact that, we don't have very strong consumer loans anymore. Some of the salary and wage growth at high-end sectors has softened a little bit. And rural consumption hasn't yet picked up. We're all hoping it picks up, but it hasn't yet picked up. And then there was government expenditure, at least in the first 2 months of the quarter. It was quite weak. We were coming out of the elections. It only picked up in the September month, but we haven't really seen all of its growth impact yet. So putting all of it together, the September quarter will not look very good.
Okay. So what about the rebound? I mean, okay, that is done and dusted. We saw the Nifty earnings also was just about 2%. The performance of companies was also a little underwhelming. What about second half? I have a wide range with some people expecting lower than 6.5 also for the second half. And of course, the Reserve Bank standing at 7.4.
Right. I'm a little more constructive on the second half. And I think for me, the big change could be rural India. Already, I'm seeing agriculture data picking up. My sense is we've come from a very bad agriculture year. The money farmers made in the summer crop, Kharif crop, they didn't use it for spending. They used it to build back savings. And I can actually see it in the Jan Dhan cash balances that, rural Indians have. But I think the money they make from the winter crop, which we see in February, March, I think that will be spent more on consumption. And then we can see an uptick, in consumer staples, two-wheelers, the kind of things rural Indians buy. Also on the side, we have government which has given out a lot more money for capex over the last couple of weeks. Once that starts and that construction boom begins, we'll see remittances go back from urban to rural India, something that had stopped in the last couple of quarters. So my sense is, and I'm looking for a rural rebound, not immediately, but around February, March.
Oh, okay, that far. So Q3 is still a bit of a question mark. Now, the other question marks which other economists are putting is that, for instance, I think yesterday India Ratings put out that report that government can't spend all its money on capex. And we had, I think, the DEA secretary admitting that they may not reach the target. The problem could be that, in the last 3 months, there is only that much that can be pushed because the government becomes busy with budget, etc. The other reason is that the absorptive capacity of the economy is only that much. You can't push, 11.2 lakh crore that you think should be put in, that many engineers, that many ability to draw up plans and the ability of the economy to absorb. Are you worried that capex also may not grow so much?
So look, I hear what you're saying and I agree with you. We lost 4 or 5 months because we were in the election process in which a lot of new capex, files getting approved doesn't really happen. So we've lost that. But I'm going to only focus on the upcoming months, and I think that things can look better than it was in the past, because I think the first half of the year, the government focused on current expenditure, subsidies, revenue expenditure. Second half, that money is going to be put more on capex, and I'm seeing that in the data I track. Also, some of the data we track on NHAI projects coming up, I think they all show that things will look good. But for the year as a whole, Lata, I don't think we are a 7.5% plus economy, which is what we had gotten used to in the last couple of years. I think we are more like a 6.5 to 7, which is a percentage point lower than 7.5 to 8. And I think this is the realization which all of us, the equity markets, corporates, are going through. Maybe 7.5, 8 came from low base. Some new sectors like GCCs coming off a very low base, growing very fast, but you can't sustain that. I think we'll now be more a 6.5 to 7% economy in the next few years, which in itself is very good.
Okay. No, I'm throwing, kind of the devil's advocate questions at you. I think the Reserve Bank got it right last year, much more than the street. They were positive about growth, and it turned out. So maybe they have a trick or two, which we don't know. I'm just looking at the doubts the market has, and one of them is cost of capital. See, the Reserve Bank may not have that much scope to cut. You tell me, what are your expectations? And secondly, even liquidity. They were generous with liquidity earlier this year, but now, since they have forced to sell dollars, they are obviously draining liquidity. There is a dearth. I mean, there is a chance that liquidity will not be plentiful. Equally, for both reasons, do you think credit offtake may not be gangbusters?
Well, look, I think easing monetary policy, RBI is looking at two things. One is inflation, and the other is what happens to the dollar, like the FX markets generally. The good news is I think that inflation is coming off. Even in the last week, we finally started seeing vegetable prices come down. My sense is inflation will fall from 6.2 in the last month to 5.5 in November, which is a pretty substantial fall and could fall even more in the next couple of months. So inflation is not my number one worry. What I'm really looking at is what happens to the overall dollar index. If at some point we realize that it has overreacted and it stabilizes or weakens, I think the RBI will get its chance both to cut the repo rate and also to rebuild its FX reserves, which in a way is how you can infuse domestic rupee liquidity back in the system, and things will be fine. Except that I don't see this dollar retracement right away. So I think the December policy meeting, the RBI will not be able to do very much. And our best hope is that something comes up in February in terms of monetary policy easing.
Okay, you expect a rate cut in Feb?
That is our forecast for now, but a lot depends on the dollar environment, and in a way, I think it's a toss-up between February and April. But our call is for a Feb right now.
Okay. Now, what's the sense that since now you handle ASEAN and a much larger part of the world, what's your sense about global economic growth in calendar 2025? There will be this US exceptionalism, there will be this threat of tariffs, and there is generally a feeling that business investments fall at a time when there is policy churn. It happened in 2018 when Trump raised tariffs and business confidence or business investments fell. So do you think global will be a headwind for us and not a help?
Well, look, at an environment of rising tariffs and policy uncertainty, things like FDI flows, all of them slow. So yes, from that perspective, we need to brace for lower growth. But I'm going to take go a level deeper. There can be winners and losers, right? And I think India has its task cut out. My sense is that in the last decade, we haven't really been able to gain from supply manufacturing chains getting rejigged in a major way, particularly for mid-tech manufacturing, like textiles, clothing, footwear. A lot of the business actually has gone to, like, say, Vietnam or to Mexico. But over the next couple of years, I think India has been given a second chance to actually grow its manufacturing base, attract some of this mid-tech FDI, and which, by the way, is also like jobs accretive, and this is our chance. So I'm going to be positive that yes, the environment is not great, but within that, if India plays its cards correctly, it could actually come out on the right side.
Okay, so you have a FY26 GDP number?
My midterm GDP growth number is 6.5%.
Okay.
Which I think is a good number in the current global environment.
I had at least half a dozen economists telling me that. They have between 6.3 and 6.5 for next year. which is far slower than what we have got used to in India in the past 4 years. But they keep saying that in this environment, 6.5 is a damn good number if we can make it. Just a final word on, inflation itself. Not all economists are that confident. There are a couple of people who are, forecasting 6% even for November. And there is a fear that, going forward as well, we may not be able to see that much of a fall because of stickiness in food prices. But do you think we are at 4% inflation for the coming year, FY26?
Look, I worry about a lot of things, but inflation is right now not my number one. And I'll tell you why. I think with, excess capacity, Chinese excess capacity, with a fairly hawkish central bank, which is keeping second round inflation expectations quite contained, I think core inflation will remain range bound over the foreseeable future. And then it comes to commodity prices. My sense is if global growth is going to weaken, commodity price will actually fall. And then the third is food prices. Impossible to predict given all the climate change events. But right now, because temperatures have normalized, reservoirs are full, I think the next 4 to 5 months, we can see food prices come off. Oh. So I do think that by March, we will get to inflation, which is less than 5%. Over the medium term, I think we will come at about 4.5%.
Okay. No, if that is a problem, less to worry, so much the better, because that impacts everyone, and it's a big, good, positive takeaway that we don't have to worry about inflation around the 4 handle. What about dollar rupee? Is there an internal HSBC range? Does it go to 85? Does it cross 85? How do the next 6 months look?
Look, our sense is that we will have to brace for a gradually weakening rupee versus the dollar, and we have a call for about 86 over the next 2 to 3 quarters. So gradual depreciation.
Okay, so FY26, let's prepare for, or whatever, calendar 2025, let us prepare for an 86 handle on the currency, but the positive would be inflation. And perhaps growth, with a bit of luck, should make it to 6.5%. Thank you very much, Pranjal Bhandari, for joining us. Just one final question. What is the big number you will watch out for when the GDP numbers come out today? Just help us train our eyes.
I'm going to look at this gap between GDP and GVA, which has bothered us a lot. We've had like a quarter in which GDP is way higher than GVA, then we have GVA way higher than GDP.
What about private final consumption and expenditure, consumption and capital formation? Consumption and investment, is not that a big worry that...
Yeah, so look, the thing is, I would love to look at what's happening to private consumption, because the slowdown that we are seeing, I think it's coming from consumption, right? Rural and urban. The only problem is whatever data will come out today, in a couple of months' time, it's going to be revised. Okay. Because in a way, it's the balancing item when Mospeak comes out with its GDP on the expenditure side. But surely I'm going to take a look at that. And it'll be very interesting to see that, is it very clear that we are more an investment economy than consumption? I do think we need a couple of quarters of consumption being high so that a new round of investment can come on the back of that.
Fair point. I mean, I would watch very closely for that. Of course, it's lagged data. It's data up to September, and we are all hoping that the festival season has improved consumption. Thank you very much, Pranjal Bhandari. We will remember all that you told us to look for when the GDP number comes out today. That's it on this edition of It's the Economy. See you at 4 or 4:30 when we will have the GDP numbers.